Hello guys, welcome back to ESENtaxa. Andrea Papito here, and as always here today I'm going to explain you on this whiteboard a very important topic. It's about to understand where you have your tax residence and when you have situations like double tax residency or double fiscal residence in two countries, and you have to resolve this problem with the tax authorities of those two countries. So this is a quite important topic. It's something that happens quite often whenever you move to another country and you left your country of origin, but you forgot to remove your ties, to break your ties, such as family ties, your permanent home, your lease contract, and this kind of thing. So the previous country still considers you tax residents, but also the new country considers you tax resident. So in this video, I'm going to explain you exactly how to exploit the double taxation convention to avoid the double taxation, the tax treaty, in which it's explicitly written how to fix this problem and which country is supposed to tax you correctly without having any problem with both tax authorities. If you're new in this channel, ESENtaxa talks about the taxation in several countries in Europe. We focus on Italy, and we also help people to relocate to Italy to understand the taxation, the fiscal system, and we help our clients to plan a long-term relocation, optimize the taxes in a future planning, a future relocation, in a long-term relocation, such as 10 years, 5 years, etc., etc. But also we focus on digital nomads and other kind of categories that wants to exploit Italy and pay less tax. So what about these breaker rules? This is something that you will always find in the convention to avoid a double taxation between two countries. This is always, or in most of the cases, it's written in Article 4 in these conventions, and actually it tells you exactly how to fix the problem of a double tax residency. Now, let's imagine this scenario. You want to move to Italy, okay? In the country of your origin, you're coming from, for example, UK or France or Germany or whatever country in the world, and you left in that country the residence in your commune of residence, or simply you have still your home. With all the bills, all the electricity bills, or other kind of utilities of this home at your name. So it's like that you are, at the eyes of your country of origin, actually you are still have your utilities at your name. But you move to Italy and you register your name in the commune in Italy, or you passed more than 183 days in Italy. So in this case, you might be considered taxable or fiscal residents in both countries at the same time. But this cannot happen because the Convention to Avoid Double Taxation, the international tax rules, requires you to have only one fiscal residence for each fiscal year. A fiscal year, normally, it's a span of time that starts from the 1st of January up to the 31st of December. So you're supposed to always have one fiscal residency because only one country could tax you worldwide, while the other countries can only tax on territorial basis. Okay, so if you don't understand this concept, territorial basic taxation and tax residency, in this channel ESENtaxa we talk a lot about these things. You have plenty of video in which I explain you the problem of tax residency and the problem of moving to a country to another, or the problem where you are taxed potentially nowhere. But here we're talking about the opposite problem. So you might be taxed in both countries. So you're tax residents in two countries at the same time. Now, how do we fix this problem? First of all, we need to see which of those two countries issued the document, the famous document called tax residence certificate. So the first things that you have to have from your country in which you want to be taxed worldwide is the tax certificate. So once you have the tax certificate, it means that that specific country wants you to tax worldwide. So it will take into account all your worldwide income, and all the entire worldwide income will be taxable in this specific country. And you don't want to be taxed worldwide in the country you're coming from. So that's important thing, because both countries cannot tax you worldwide at the same time. That's for sure. So you first need to require this tax certificate. This tax certificate is issued by a country towards the other country that wants to tax you as well. For example, you move to Italy, but Germany still asks you to be taxed worldwide. You ask Italy the tax certificate issued towards Germany, and Germany has to stop, cannot tax you straight away. But you have to find a way to understand in which country you really are taxable worldwide, which means be the fiscal resident. Now, the tie-break rules allows you to understand in which country you really are fiscal resident. So once you have this tax certificate, it means that you can say to the previous country against the country of your origin that you are going to move, you're going to live in this new country, and this country officially releases you this tax certificate. But if the country of origin also can issue the tax certificates, this means that we have to invoke the tie-break rules explicitly written in Article 4 of our Convention to avoid the double taxation. In this Article 4, we will understand in which of two countries you will be able to be taxed worldwide. First things that we need to see, and this it's a like hierarchical element, so we have to take in as a priority one by one. So the first things that the countries are going to analyze in your specific situation is the permanent home. So the permanent home is like possessing or owning a property, or have a lease, a long term. Okay, so basically you have a 1 year, 2 year, 3 year contract, or you have a real estate property which normally you live. So if a country sees that you have this permanent home after having issued a tax certificate, you will be tax resident in that specific country. Now, if you have permanent home for most of the time in both countries, or you don't have any permanent homes in any of these two countries, at this point you have to analyze the second point. The second point of the tie-break rules is the center of vital interest. And the center of vital interests are basically divided in two subcategories. Most of the countries divide this international rule in subcategories. One category is family ties, and the second one as a priority, so this is 2.1 and 2.2, center of your affair, of your business, of your work, of your business. So basically the two countries that wants to tax you, they first check the permanent home. If you're not able to understand which is your permanent home for most of the year, they move to the second element, which is the center of vital interests. I mean, going to the center of vital interest details, you have family ties in your country, for example, going back to the previous example, if you have family ties in Germany and you move to Italy, so you have your wife and your child in Germany, you are still tax resident in Germany, even though Italy issued a tax certificate. So it's not enough to just move if you have a family in another country and pay taxes only in this new country. Because based on the tie-break rules, which is an international rule agreed between two countries, if you have a family in the previous country, in the country of origin, you still are tax residents there. And the second, if you don't have any family ties, then the countries check your center of your business, so where you actually carry on your work, the majority of your affair, majority of your business, the majority of your work life. Okay. Now, if those two elements are not enough, because there are situations in which you really pass half of the time in both countries, so you don't have family ties, you don't have permanent home, you work half of the time in one country and the other half of the time in the other country, we go down and we going to check the habitual adobe. And here it's actually the famous presence test. Actually, how much time, how frequently we go in a certain country, or simply how much time we spend in a country, in terms really counting the days compared to the other one. Of course, it's the famous 183 days. Okay, if you pass more than 183 days, regardless the previous two elements, because the two countries they didn't manage to understand in which of the two countries have permanent adobe and the center of vital interest, at this point they are going to check the physical presence, which is not easy to prove when you are in Schengen area. So if you're going down with these tie-break rules, there are some documentation to prove, and this is going to be complicated to understand, to show to the tax authorities exactly how much time you spend in a certain country. It can be simply how much time you withdraw your money in your ATM in the bank, so that proves that you were physically there in the country, or you passed some days in some hotels, some beer, bed and breakfast, etc., etc. So any kind of document that can prove your presence in a certain country. And if also these things is not possible to determine because you didn't pass the majority of your 183 days, and maybe because you're a perpetual traveler and you didn't pass enough time in both countries, they're going to check the nationality. The nationality is the fourth point in terms of priority. Any of the first three are not verified, they are not possible to understand, you don't have enough documentation of the country that cannot prove the contrary, they're going to check the nationality. So the nationality attracts you as a tax resident of that specific country. So German resident, you go to Italy, but you don't have the first three elements verified, you're still German tax resident, okay? But if you have a nationality of those two countries, could happen, then we have the latest point of the tiebreaker rules, which is agreement between the two tax authorities. Agreements between the two tax authorities. So the two tax authorities will decide among them where you have to pay taxes worldwide. So this is how to understand where is your fiscal residence and where you have to pay your taxes worldwide. Now, if you don't have the way to issue and present to the tax authority the tax certificate, you cannot invoke the tiebreak rules. So the tiebreak rules, it's something that is written in the convention to avoid the double taxation. So if a country considers you tax resident and also the other country considers you tax resident, so it means that you can potentially ask the tax certificate from both countries, then you can invoke the tiebreak rules. But if you don't have a way to provide a tax certificate because you are a perpetual traveler or because you didn't pass enough time to require this document from that country, the tiebreak rules cannot be invoked. And this means that it's enough only the presence test to be considered tax resident in a specific country. Okay? So this is something that is taken as important element and important tests only after have at least the tax certificate in a specific country you want to relocate in. This is one of the most important concepts because maybe it's misunderstood. A lot of people think that I pass my 183 days in a certain country, then I'm automatically tax resident. It's true unless you have this document with you. And then we have to analyze carefully the tiebreak rules and the convention to avoid the double taxation between the two countries that are trying to attract on their tax sphere. I hope it was clear. This kind of topic are not so easy to explain. We try here in ESENtaxa to make it simple. If you have any questions, any doubts, if you didn't understand correctly this point, you can write us at info@esentaxa.com or you can visit our website www.esentaxa.com. You can see our services. We mostly focus on relocate to Italy, but you can also book 1-hour call in which we can discuss about these international tax rules, international tax issues, and we can help you to relocate into different countries, but mostly we are focused to Italy. So, if you like, again, this content, please notification bell, like button, and subscribe to the channel, because in this way you will be always notified when we release a new video about these topics, or about Italy, or about another country in Europe. Thank you, and see you the next time.